Welcome everybody to this first installment of the EBI Policy Series. Today the topic will be about the ECB consultation on the draft guide on the supervisory approach on banking consolidation, a very important and up-to-date topic because there's an ECB consultation at the moment. A very much welcome to this policy series, Edouard Fernandez-Bollo from the ECB, who is a member of the SSM Supervisory Board as an ECB representative. Very much welcome, Edouard, that you participate in today's session. And I also welcome Christian Ossig, who is the Executive Chairman of the European Banking Federation and the CEO of the German Banking Association. A very warm welcome also to Professor Christos Gortsos, who is the President of the Academic Board of the European Banking Institute. Welcome, Christos. In our audience, we have a lot of a diverse audience with representatives from the ECB, the EBA, also people from Bundesbank, Banca d'Italia, Bank of Portugal, Bank of Greece, and BaFin. A lot of academics as well. So very much welcome to all of you to this series. Let me start explaining, first of all, let me spend a few words on the background of this policy series. So the EBI started now with its work about 4 years ago in 2016, and the aim was to encourage pan-European research in the area of banking, banking regulation, banking supervision, and banking resolution. Its approach is interdisciplinary, so we are covering the areas of law, economics, and accounting, so the key topics when it comes to banking. And the EBI has launched a very successful academic work series, which is exemplified with its working paper series, which is publishing on a weekly basis a lot of new papers and academic conferences all across Europe, which are always culminating in the global annual conference, which is the academic key conference of the EBI every February in Frankfurt. We are doing this already for the 5th time. A very great thank you also to all the academics in the academic board from all across Europe, which are essentially the key pillars of the work of the EBI. We now thought it's also time to start a policy series because there have been a lot of regulatory changes in the last 10 years since the global financial crisis, which are affecting banking, meaning we have an introduction of the CRR, the CRD in various forms right now. A banking union has been started to be established. We have the SSM, the SRB, and other institutions. And this crisis that we are now facing due to the coronavirus will lead to additional changes in the policy sphere. That's why we as the EBI would like to share also discussions on policy matters and herefore invite people, policymakers, high-level policymakers, which basically share their thoughts with us in this regard and where we can essentially provide a platform for an open discussion and in this way also contribute to the public debate about various topics. Today, the discussion will be about banking consolidation and the ECB guide on the supervisory approach on banking consolidation. It's a very important topic because obviously the SSM was also created in order to create a European banking market, further pan-European consolidation. In all honesty, this has not happened as I guess many have wished for. And the ECB has now taken the initiative in order to provide some guidance what the supervisory approach would be when it comes to a discussion about mergers, national but also cross-border mergers. And Edouard Fernandez-Bollo has been a key person leading the work stream in this regard within the ECB. And I'm very happy that he's here with us to share his views and the ECB guide in this regard with us. Briefly, as an introduction for Edouard, Edouard has worked his career at Banque de France at the ACPR, and from 2014 to 2019 he was Secretary General of the ACPR before he moved then in September 2019 to the ECB, where he's now a member of the Supervisory Board of the ECB. I will also introduce right away Christian Ossig, who will basically give a short statement after Edouard. Christian Ossig has a very long career in banking. He worked for various investment banks in Frankfurt, JP Morgan, Rothschild, Bank of America, and Royal Bank of Scotland. Before then, he moved on for 2 years to become a policy advisor at the Institute of International Finance in Washington, and then came back to Germany and was from 2016 onwards member of the executive board of the German Banking Association and became CEO of the German Banking Association in 2018. So with these words, I would leave it with the introduction. Just in terms of housekeeping, a few words before I hand over to Edouard. After the introduction and the keynote of Edouard, there will be a short 5-minute reply with a view from the Banking Association's point of view on this ECB guide. And then Christos, Gortsos, myself will chair and host a discussion. And we will have some questions that we will ask to the panelists directly. But afterwards, we will also open the discussion to you. In order to participate in the discussion and ask a question, you will have to use the Q&A tool here in WebEx, and we will read aloud your questions to Edouard and to Christian. With these words, I would like to close my opening remarks, and then I would hand over to you, Edouard, for your opening keynote speech. Thanks very much. Well, we cannot hear you right yet. Edouard, we cannot hear you. We see the presentation, but we cannot hear you.
Thomas, I guess Edouard can't hear you either. You need to give him some hand signs or call him on his mobile phone.
Yeah. Can you come in? Hear me? Okay, he hears us, but we cannot hear him. So, jetzt ist er auf Mute. Können wir vielleicht unmute machen? Jetzt ist er.
Can you hear me?
I hear you. Now we hear you.
Oh, okay.
Perfect. Now you're gone again. No, we cannot hear now.
Aber he's on mute as well.
Can you hear me?
Now we hear you.
Okay, well, sorry for this incident. I hope it will not be repeated.
So, the presentation now.
Can you hear me and see the presentation? Okay, well, let's go with it. I was just beginning by thanking you, of course, Thomas, and more largely the EBA, to give me this opportunity to share with this audience this question, because as I will want to underline as a first thing, it's very important for us, this consultation, because the ECB, as you said, has been working for already more than 6 years in its function of supervisor. One of the things that we observed at the end of the first period of 5 years is that we needed to increase the transparency of this new supervisor in order to be better understood by the market. It is clear for us that the efficiency of the supervisor is greatly helped by increased transparency. And because that allows the market to adapt to understand and to adapt its behavior to the expectations of supervision. So it is a factor that is very conducive to financial stability, which is our ultimate goal. And I would say this, which is a general evolution of ECB towards more transparency in the supervision, is of particularly used in this field of consolidation, because it is an issue on which, on the one side, ECB has said a lot of things. We have a consistent record of, as ECB, and I will say not only supervision, but ECB as a whole, as trying to foster the integration of the single market in Europe and in the Eurozone in particular. We have been very outspoken about what the benefits could be of this additional integration. But on the other side, we had the distinct perception that some people in the market thought that when we came to the real practical issues, in fact, the role, and here I'm speaking clearly about the role of supervision, was such that in practice we were acting as an obstacle to the furthering of consolidation because of the maybe a bias of supervision to try to build up security layers for every decision of supervision that we do. So I think it was very important to come out in the open and speak clearly about what is our role and how we think it's the best way to develop this role, to implement it in the practical cases that we are seeing as supervisors, and then to have a discussion in the public about what are the main issues where there could be a gain in perception by us of the needs of the market, but also of the market of the supervisory expectation, so that can facilitate the evolution of the market. So the first thing that I wanted to say, and here in EBA, because we are speaking with a lot of academics, maybe it's not as necessary that in other audiences, but I really want to insist on it. We are here presenting the role of ECB as supervisor. So how it applies, the framework as it does exist. So we are not initiating a conversation that has its own merits about whether we need to change the framework, the European framework. It is an interesting conversation, but it is not the one we are pursuing today with this paper. What we want is the market to understand what do we do as supervisors in the prudential framework. And it is 3 points that we wanted to underline. First, that our approach is not to design the market. We are not also market participant. We are not saying, we are not here to dictate what is the right level of consolidation, what are the right projects of consolidation. This should be left out. The other is to ensure that the market as a whole, and then each individual group that is supervised by the ECB, acts in a way that fosters financial stability, and that means that we comply with prudential requirements. Of course, that's the core mission of a supervisor. But in order to ensure that we comply in a permanent way, we need to look at the sustainable business models that ensure this compliance over time, and to underpin these sustainable business models, we need to have sound governance and risk management arrangements. So this is the way we look at the consolidation, to be sure that the project of consolidation do enhance the capacity of the individual banks and of the system as a whole to comply with these objectives of financial stability as we are in charge of it. So in this room, what we try to do with the document we have published and with this interaction we would very much like with the market is to clarify our approach and make it understood how we apply the principle of proportionality, that is an overarching principle for our supervisory approach, to the issue of consolidation. So how it will be used, how the supervisory framework will be used by the ECB when assessing the project, and so to increase transparency and predictability. So I'm very much looking forward, of course, to all the feedback I can have on that in this session as in the overall consultation that is open and current. So we will have first in explaining our process, how our process to approach the consolidation initiatives is framed. Not surprisingly, what we encourage is that when market participants, some parties in the market intend to carry out a consolidation, we encourage them very much to interact with the supervision at an early stage, because that means before publicly informing the markets, because this is an early stage where I think a lot of important issues could already be discussed and explained between the market participants and the supervisor, and that will make the process more smooth. Then what we will do when we receive formally a project, we will assess them on these key supervisory issues that I mentioned before: the sustainability of the business model, the governance and risk arrangements, in the light of the integration plan. And the message we wanted to carry, the essential message that we wanted to carry with this consultation, is that when we have sustainable projects that do not raise any substantial concerns, I mean, substantial negative effects of resolvability and financial stability, and we are very much aware, we are supervisors, that in the past and before the crisis, for instance, there could have been issues of that, they will be subject to a dedicated supervisory approach, which will try to elaborate on the benefits of the consolidation project. So we will take into account the benefits that a consolidation project can bring to the reliance, to the enhancement of the financial soundness of a bank and of the system. We will take that into account in adapting our supervisory approach to the project. And of course, because we will base our approach on the project, then we need to follow very closely how this project evolves. So after we make our assessment, we will follow during the lifespan of the integration plan, we will make a dedicated follow-up of the situation of the bank. On this, on the contents, on the substantial contents of our supervisory decisions in the framework of this consolidation project, our previous interaction with the market participant showed us that there were 3 points where maybe we had to dispel what, from a point of view, was a misjudgment of the market of what is our approach. First point was, what are the supervisory requirements for capital that can be defined in the framework of a consolidation project? First, we have a message that is a message on process. We are ready to engage on what will be these Pillar 2 requirements in parallel to the authorization project, and with a view to remain stable for a year, because we know that, at least for a year, because we know this is important to provide the consolidation project with, I would say, security, some degree of reliability. And last point, which is also very important, I think, that our starting point for determining these requirements will be the weight average of the involved entities. Of course, I am here, and I may say it for all the other things I will be describing here. We are in the case where we have 2 entities, of course, that we know them and that are in the remit of ECB. We will adapt the same principles to other cases where it will be not a merger between 2 Eurozones. Second point that has been also very important in our communications with the market is, how do we look at badwill? And again, I think the clarity we want to give to the market is that the starting point is that duly verified accounting badwill is recognized in principle also for prudential needs, which is in full compliance with, of course, the CRR, the regulation. And what is our particular way to look at it in the framework of consolidation project is the expectation about its use. It's clear that the presence of badwill is something that makes easier to have a consolidation project, because especially when we have a consolidation project that are paid in by shares, then the presence of badwill makes, I would say, easier to sustain the prudential requirements after the consolidation. So that's fully recognized and can be fully legitimate consequence of the existence of badwill. What we want to be sure is that there is a stability of these own funds, and so that there is no distribution of badwill unless we are satisfied that the sustainability of the combined entity is firmly established. And a third point, which is also important, it has a really practical bearing on all the projects we've been seeing, is that we are ready, in the frame of our consolidation projects, to have temporary situations where entities involved in consolidation may continue to use their internal models, also for new legal entities, until we have a rollout plan of validation of the new models for the new business entity. But we are ready then to define, as appropriate, with partners in the consolidation project, how much this rollout will be and what are the important timeframes for doing this. So with these three main things, but we have 10 pages about it, so I would be happy to have questions also on the other aspects of what we are trying to clarify to the public. We have open a consultation until the 1st of October. In this month of September, where people are back from the holidays, we are making a lot of interactions with the public, and we are really looking forward to receiving your feedback, and we plan to integrate the feedback and to revise the document for the fourth quarter of this year, so that we have a fully fledged and defined policy that of course we are also applying for the time being, but that will be in place for the next year. So with this, of course, I will be now happy to hear the views of the banking federations and afterwards of the public on these issues. Thank you very much for your attention.
Thanks very much, Edouard. 1 second. Okay, then I would pass on the word. Thanks so much, first of all, for the introduction to this important topic. I mean, the timing is quite apt. We have discussions about mergers, or mergers actually taking place at the moment as we speak in Italy and in Spain. So we'll see what's happening out of this and whether this guide is already having some influence on our work. But obviously, it's also a current discussion and a consultation. It's why every kind of input would be very useful, I guess, also for our work in the ECB. These words then I would introduce again Christian Ossig to this discussion. I have forgotten before that Christian actually has been very active in M&A advising financial institutions. So he has been working in financial institutions and heading their respective departments for M&A advice to financial institutions. That's why I'm very interested also on his view on this ECB guide. From a, let's say, German banking association perspective, but from a European perspective as well. And then obviously from somebody who has worked in this area from the other side, from the receiver side. So with these words, I would hand over to you, Christian. The floor is yours.
Thank you very much, Thomas. I hope you can hear me.
We hear you well.
Very good. It's a double premiere, I believe. It's today the first EBI Policy webinar, and I would like to congratulate you and the EB team for this. Looking back what you have achieved within really a few years, bringing together policymakers, academics, and industry, this is really very impressive. So it's a premiere to have a first webinar. I believe it's the first one. It's also a premiere for me because we have built at the association here in Berlin a new video room. So it's the first time for me sitting here in this setup and having the pleasure to do that. Three things I want to make in my upfront remarks. A few general comments, then I would like to share some perspectives on the ECB approach taken there, and then I would like to say a few words specifically on the consultation. General remarks, first of all, I would like to congratulate the ECB and Edouard for taking that initiative, because the topic to foster consolidation among European banks is incredibly important. We need more integration, both in a domestic context as well as cross-border. We all know that European banks, by all measures, looking at it from a market's perspective, price to book values, looking at it from a profitability perspective, European banks are lagging behind the US and Chinese competitors. And part of that has to do with the lack of integration we see in Europe, not only within banks, but foremost also in terms of market integration. If US banks have the level of profitability they have, that is largely driven because it's a very deep, liquid banking and capital markets in Europe. We're missing that. And when we talk about banking union, which has led to having an SSM, it should not be misunderstood. Banking union is not about market integration. Unfortunately, it is not about market integration. Capital markets union is more about market integration. My read of banking union is that it has been very much focused on creating a stability framework, European supervisor, a resolution mechanism, and we talk still about the deposit insurance scheme. What is needed here is a banking union in a different sense, which means an integrated European banking market, and we are still very far away from that. And a very good indication to where we stand today is if we listen to investors, and Thomas pointed out that I have a background in investment banking and M&A. Investors, even today, they do not look at the European banking market. They buy a US bank, but they do not buy a European bank. They buy a Spanish bank, a French bank, a German bank. And that is a very clear indication, from my point of view, what is needed here and why cross-border consolidation is of particular importance. And also it has to be said that COVID has increased the need for consolidation even further. There is more pressure on banks to realize efficiency gains, but there is also more pressure on banks to serve the European economy. And I'm coming back to the question of cross-border consolidation, and I'm fully aware that Edouard's initiative is not specifically on cross-border consolidation, but if we were to have more cross-border consolidation and more market integration, that would be a huge step forward in Europe in terms of risk transfer, and probably a much more important step forward in terms of risk transfer in Europe than any public package, aid package can possibly deliver. So bottom line, we at the European Banking Federation, at the German Banking Federation, we very much welcome the ECB approach, and that you want to support consolidation through a process of clarification and more transparency on its supervisory approach. Looking at the ECB approach, two remarks there. And Edouard was very clear, this is about a supervisory approach. This is not about legal changes. However, I'm afraid, I think that in order to really foster consolidation, the supervisory approach helps. What we need also is very much a change in the legal framework. There are legal changes badly needed that we are missing today, and that relates to harmonizing banking-related rules as well as harmonizing more general private law, for example, insolvency law-related rules. There are legal barriers, and I just want to cite one of them. That is the question of using capital and liquidity waivers. We are very disappointed as a European banking industry that the question of waivers for capital did not survive the trilogue on the CR2 changes that we saw a year ago. Changes on that regard would set free billions of capital and liquidity for European banking groups. And the second remark, as far as the ECB approach here is concerned, the ECB rightly points out that drivers behind consolidation have to be the owners, has to be the private sector, that should belong to the market participants. The ECB talks about facilitating this process, and that is correct. It should not play an active role or some kind of nudging, giving hard incentive to go down that path. Especially, I'm very convinced that any discussion on consolidation should remain free from political influence. The bottom line, I guess what I wanted to say here is if we're serious talking about consolidation, we need to look at regulation, and I understand, and Edouard was very clear that is not the focus of the discussion today. What does not help, and that would be my final remark before looking to the consolidation, is we still look at the world. We have a single supervisor in Europe, but there are national entities that still play a very important role here. And I would like to give you some examples where I find it becomes very tangible. The first is the combined capital buffer requirements includes country-specific Ossig buffers, and they are being set at the discretion of member states, and there is no certainty as to how these requirements might change following a transaction. So that is one example where I would feel there is still too much fragmentation, maybe too much power with member states. And the second example is in our view, there should be a fast-track procedure for the fit and proper assessment. Management in the situation of a merger must be immediately operational after a takeover or an M&A situation. And the first few months are crucial, and reducing the time lag for fit and proper, that would be a very important step forward. I probably would not carry on now sharing some insights on the consultation specifically. Maybe I stop here, because it's probably more interesting for participants to have a dialogue, and then spare my remarks specifically on the consultation, especially also on badwill for the discussion.
Thanks very much, Christian, for your statement on this topic. I would now, together with Christos, open the discussion with a few questions from our side. And in this regard, I would also reiterate that you will be able to ask your own questions via the Q&A tool, and we will read them aloud. So in that sense, let me open the discussion with a quick look back now to the last 5 years of the SSM. I mean, we have seen some consolidation. It was, however, mainly on national markets. Christian was hinting at this as well. Why is the ECB now coming out with this consolidation? Edouard, in some of your interviews you gave in relation to this consolidation, you were also referring to the profitability of the European banking system, and then looking at, let's say, the German Banking Association. German banks are even less profitable than the European banks, but they're all way behind the US banks. What is the key driver for the ECB to come out now with this consultation, with this draft guide?
Thank you for your question. In fact, there are two drivers. The first one, I just briefly allude to it. It was 5 years after we tried to see what we could improve in the supervisory approach, and we decided that transparency in general was something where we could improve. After 5 years, we are more confident in that we started from zero. We had to create a new European approach out of 19 different approaches. And now we have made this approach, we have created it, we have used it, we have the gain of experience, so it's time to make it more well known and to be better understood by the market. That was the institutional part. But the other part, at which your question points, was also very important, is that 5 years after, we've seen, in fact, a very big increase in the capital ratios of the bank. So on that side, we could be satisfied with what happened. But we have seen, unfortunately, that there is insufficient internal capital generation by banks. Because while we are looking at profitability, we are not the owners that have an interest in profitability, I'd say. We are interested in profitability because it makes the business model sustainable, because it can create capital. And we do think that a healthy bank is a bank that has enough internal capital generation. And what we see there is that, and of course, we should see that through the cycle. Well, last year, when we began this work, we had been through a cycle. And what we have seen is that the internal capital generation back through this cycle was extremely weak in Europe. So it's not that this year there was a problem. It's that through the cycle, we've seen there are structural constraints on the European banking sector that are not playing the same, for instance, in the American sector or in the Asian banking sector, that are keeping the European banking system as a whole to generate enough capital to keep up. So one of the issues, not the only one, but one of the issues is clearly the fact that the market is less integrated, and we are in a situation where, in some respects, we are much more integrated than Asian markets. We can compare to the American markets in some aspects of the framework, but yet on the economic side, and I unfortunately, I just can agree with Christian, the market is not yet looking at Europe and even at the Eurozone as an integrated market. And this is one, not the only, but one of the key issues for the structural capacity of generating capital of the European banking system. And that's why we thought it was very important. Just in one word, of course, it was not because we were having pre-signs about the COVID crisis. It was really because of analysis of the through-cycle performance of the banking system in Europe.
Thanks so much, Christos.
Thank you, Thomas. First of all, let me start by welcome you all and joining Thomas in thanking Edouard and Christian for participating in this first event, policy event of the EBI. I know from the draft, and I have heard you again and again, Edouard, saying that this paper is not about the regulatory framework, it's about the supervisory expectations. But still, I'm curious, yeah, whether there are some elements in the regulatory framework that might need to be adapted. We know that the field of mergers and acquisitions is not touching only upon the rules of the CRD4, yeah, on the regulatory requirements. It's about capital markets regulation. It's about competition regulation. Yeah, it's multidimensional. But still, are there any elements in the regulatory framework which you have identified as requiring some adjustment?
Well, you're trying to bring me forward to the other debate that I wouldn't want to spend much more time. Of course, there are a lot of things that could be done, and we have repeatedly said that. But and in particular, for instance, the capital waivers. We were in favor of capital waivers. We think it's important of the capital waivers, lifting the restriction on large exposure, the national discretion on large exposures, harmonizing the governance, risk management, and fit and proper regulations in Europe. We have, in many instances, said that there were issues that were very important to do. But what we have seen is that it's not easy to advance on the regulatory side, and we are not responsible for that. So that's why, because we've seen these difficulties, we say, let's do what we can. Because for the supervisory approach, we can do it. So let's do our part, and we hope that this will also induce the others, the ones that have the regulatory powers, to do their own part. If they see that already with this we can make some progress, I think this will go in the way of the other progresses. For the other progresses, again, ECB has consistently advocated changes in the regulatory framework, and we still advocate. But each task for its time, and I think we are doing the better by doing our part to foster the other part of evolution.
Thank you.
Thanks very much. Then, if I might continue with one question about cross-border consolidation. In a banking union like the Eurozone is aiming to be, obviously, this is, I guess, the key part of the target of the SSM, to have a European and integrated banking market. It's got a lot of advantages, and Christian Ossig referred to some of them. The private risk sharing between different countries, looking into the American banking system. This is, I guess, one of the key qualifications which makes the whole system more stable, because you have an integrated market where risks are transferred from one state to the other state. And this is existing in some countries in Europe. If I look at the Baltic banking system, which is very much integrated with the Scandinavian ones, but not on a bigger scale. And in the last years, banking consolidation was mainly a national topic. What, in your view, and I would also extend this question to Christian afterwards, are the main obstacles to a proper cross-European banking consolidation? And then I would add to this question also my a slight add-on. Is European cross-border banking consolidation in the time of digitalization, in the time when big data companies are really the big, or can become the big competitors of banks, and not anymore other banks, but maybe the Googles and the Amazons and the like, and where other smaller banks, I think of now a small internet bank, N26 in Berlin, which was expanding into a lot of different European countries, not by acquiring another bank, but by just opening up internet facilities so people can essentially become client of the bank without having a branch over there. So what, first of all, what are the biggest obstacles to cross-border banking consolidation? And is this really the future, or are we not approaching an area where, let's say, banks are becoming based in one country and they expand their network via the internet, to put it very simple?
Well, to make a long story short, I will separate two kinds of obstacles. They are the obstacles that derive, I would say, from all fields of law and culture, of economics, that make a country different from another country. Consumer protection, civil law, there are differences. Not because I think they are not important, but because they are less in the remit of a central bank. Well, in our remit, I will say there is one formula that for me summarizes this, that we are not yet recognized fully as a single jurisdiction. The European Union should be a fully single jurisdiction, and it is not yet. So everything that in our financial standards is against a single jurisdiction is an obstacle to cross-border consolidation. So the fact that, for instance, you still need a national sub-consolidation, that this is in you do not have capital waivers, is one way of doing this. The fact that you have, of course, systemic buffers that are purely national is that. In that respect, let me underline that there is some progress. One of the few progresses we had in the banking package was the idea that now there is a possibility, and EBA is working on that, to consider, for the instance, the systemic buffer, to consider the Eurozone as a single jurisdiction. That's exactly the kind of progress we need to be considered fully a single jurisdiction for our financial stability purposes. But of course, we still have a road to do, because there are a lot of national option discretions, and that in the single rule book that are an impediment to this. So that will be really the first one. The second issue that was in your question is, but do we really need that? Because of maybe the banking of the future will not need to go through consolidation. First, I would say, for the time being, this is an important development, and we will look at it. But we are beginning our journey to more integration for the biggest issues. The biggest evolutions have always been by merging. So that's why we are commencing to do that by merging. But of course, you can have branching. You can have integration by branching out. And you can have integration by freedom to provide services. So it's true that at ECB, after this initiative on consolidation, we will be also looking at what we can do to foster, what can be conducive to fostering integration by other forms of single market presence that are not necessarily consolidated. Well, for the time being, again, I will not say macro level, because it's not an issue of macro, but the figures of integration through these other forms are still relatively limited. So that's why we have to begin to see why it is so that it is limited, and to see how we can accompany the growth of these other forms, also with the imperative that is the imperative of a prudential supervisor, to do it in a way that is fully consistent with financial stability. Just to tell you one thing, N26, for instance, after beginning in pre-provision of services, has begun to develop branches. That's a development that we have to understand how we do. But it's an issue for the future. For the time being, I would say the big evolutions are made at the level of the legal entities, so at the level of consolidation. I don't hear.
You're mute, Thomas.
You're mute.
I unmuted, but not me. So my question was, what do you think about this topic, Christian?
I would like to quickly react on what Edouard said on profitability, and that profitability indeed matters. And I want to start by saying that we very much welcome the industry, that the ECB in the last couple of years took a very active look at profitability. I wonder sometimes, Edouard, whether that has not come at a rather late stage, because I see that focus on profitability maybe for 2 years now, and the 8 years before, since the financial crisis, the focus was on level of capital, liquidity, not at all on profitability of banks. There is a trade-off, if we like it or not, between profitability on the one hand and capitalization on the other hand. There is a trade-off, and it's a good question where the optimal level is. And we also need to have on our radar screen that if banks are too overcapitalized in terms of profitability, that will harm. And that matters also because right now banks need to finance the European economy. That is also another aspect where profitability matters, not only from an investor's perspective. And we should not make ourselves any illusions that if we look at the different groups of investors, traditional growth investors, people that buy a bank because it's growing and its dividend strong, there are not many left. And if investors today own bank stocks, they do that for all sorts of reasons, starting by index trackers, etc. I quickly want to react on that. And now to your question, Thomas, on consolidation, or whether a digital expansion wouldn't be a superior strategy. As far as the question of digital expansion is concerned, Thomas, just as it's the case in the traditional world of cross-border bank mergers, we lack a legislative framework in Europe. Expanding on digital level in Europe today, starting by client acquisition, we still have to overcome a lot of national specificities and borders. So it's far from easy to create a pan-European digital bank today, and realizing synergies, even with a largely digital business model, might be just as difficult as in a more traditional, context. Now, why do we not see a lot of mergers, be it domestic or cross-border? The economic rationale in many cases is missing. I've been an investment banker in my first career, and we have a strong tendency to overestimate economies of scale in merger situations, both on the revenue side as well as on the cost side. And why do we not see extremely strong evidence on the cost side? It has exactly to do with what Edouard pointed out, the lack of a single European recognition jurisdiction. Beyond this, there are many other aspects that make merger very difficult. There's always the question whether there are unrecognized risks in a partner's bank's balance sheet. There is no willingness on behalf of investors today also to participate in bank mergers, and any merger has to do with a very high level of complexity. Legacy IT systems, branch networks, and all the arguments that I just mentioned, they already matter in a national context. Now put that in a cross-border context, things become even more difficult. And I think this is why ECB and the industry, we all would like to see more consolidation, more cross-border consolidation. I would be probably too optimistic if I would be sitting here and giving you now, stating in expectations that more cross-border consolidation would be around the corner. I don't see that. The current market environment, from my perspective, is not encouraging cross-border consolidation.
Yeah. Now, a follow-up question, nevertheless, on a slightly different topic. Yeah. I read in your draft guide that when the ECB will be assessing the consolidation projects, it will take into account, among all the other elements, the economic ones, also the governance frameworks. Yeah, the governance frameworks. And my question is whether you believe that there are still differences in the application of corporate governance rules in the member states, which might be an impediment to cross-border consolidations, yeah, along all the other factors, which obviously are more important, as you, Christian, said before, with regard to economies of scale and scope. So what are your expectations about this assessment of the governance frameworks, Edouard?
Thank you, Christos, for this question. I already mentioned en passant that indeed the difference of the governance frameworks is something we would like to reduce as a matter of regulatory policy. But here in the supervisory approach today, which is taken, as I said, with constant regulatory policy, what we are more looking at is the capacity to really identify and integrate the challenge of for the governance of integrating two different institutions. So how well it is planned. Well, what we want is credible. We know that there are obstacles to integrate something. That's why there should be benefits that overcompensate the costs of the integration. What we want to see in the plans is that the people have thought about it, and so have the plans and means to mitigate the risks. So that's why a very precise governance of the merger the quality of what is foreseen to identify the problems and try to resolve them. This is one of the issues we will be looking at more closely, because we know we cannot identify a priori all the issues. So the quality of the follow-up of the integration plans and the capacity to react easy. So we're having the good skills, having the good internal control mechanism to identify that is one of the key issues we will be looking at to try to assess the credibility of the plans. Because in our experience, this has been a very, very important question.
Thank you.
Thanks so much. And then I would like to ask or read aloud one question from Dr. Ioannis Minaritis. Basically, he was asking, and this is to both panelists, an inquiry addressed to a situation in connection with the early communication phase that you were hinting at, Edouard. If a proposed bank consolidation project is a hostile takeover, yeah, what is essentially expected from the acquiring bank in terms of providing information to the ECB? Because of some information is obviously not publicly available right now, it's highly sensitive. So the question is, what is expected from the acquiring bank in such a situation?
From the acquiring bank in a hostile takeover, and we have seen one lately, so we do have experience on that. We ask this bank to share its intention, its plan. How has it identified what it has identified as difficulties for the specific difficulties that you can have when you have a hostile takeover, and how they will mitigate them and how they will run. So we are not asking them to know what they cannot know, but we are asking them to know how they will deal with what they cannot know, and so that we can appreciate how prepared they are to the specific challenges that you will have in a hostile takeover. What I say for hostile is exactly the same thing for cross-border. If you are doing a cross-border, you need to be maybe more aware of the challenges that the cross-border will be that if you have doing a national. Again, what we are trying to assess is the credibility of the plan. So as the acquirer, the would-be acquirer, identify the problem and easy dealing in a credible way with them. So that applies to hostile takeovers as to any other specificity of a takeover. Has he identified the specific problems that this project will entail, and how is trying to deal in a credible manner with this problem?
Thanks very much, Christian.
Problem of confidential information. He just can tell us what he wants to do, so he can do that.
If I may, Thomas, in addition to the question of early communication, I would like to be specific on a couple of other aspects as far as the consultation is concerned. And it would be pity if we conclude that discussion without touching on the question of badwill. It is very clear that the limited recognition of badwill in CET1 would be unnecessarily and a sustainable impediment to desired consolidation. And my question to Edouard is, I'm not 100% sure, and that is something that we are raising as the EDF as well in the consultation process. What does the specific supervisory evidence of valuation issues not yet recognized, what does it really mean? Does that not leave us banks in the end still with uncertainty whether badwill can be recognized or not? That would be my first question to you, Edouard, specifically on the consultation. The second one is a concrete question in relation to the average Pillar 2 requirements. And will the ECB provide insight into the risk drivers of the entity's Pillar 2 requirements? This is what would facilitate very much the planning process of banks going into consultation. And I should have said on the badwill also, if I may go back to this only with one sentence, Edouard, in my view, badwill, to recognize that or not, that should be also left very much up to management, as opposed too much to a very stringent set of rules. I would stop here.
Okay. If I can go on in the discussion, we are in the middle of a crisis. It is a pandemic crisis. The root causes of that are different than the causes of the global financial crisis of 2007-2009. They are again different from the banking crisis prompted by the fiscal crisis in Europe. Yeah. And one of the main elements of this new development is the expected increase in non-performing loans across the board. Nevertheless, the new framework is also different. It has been shaped with new rules. We have a new pan-European supervisor. We have the capital buffers, which proved to be very efficient in absorbing losses, yeah, during the first phase of the crisis. And we have a new resolution framework, which is there in order to deal with any accidents in the system. Nevertheless, one might ask whether a new wave of consolidation in the European sector, when it were to happen, whether it would resort into more banks which would be considered again as too big to fail. Is there any consideration on this? I'm very cautious in addressing this question because, of course, the failing, likely to fail, and the too big to fail discussion in 2007 was different in the absence of a resolution framework. Now we have it. But again, may this, if it were to happen, consolidation wave leads to a situation where you would have fewer banks, potentially more robust, and I expect that this will be part of your evaluation and assessment according to the criteria I see, but still banks which would not be able to touch upon.
So maybe if I come back first to the first question on badwill, let me be clear. We are saying that we do not expect not to recognize badwill. We are on the contrary. We are going out publicly saying normally it is recognized. What can be problems of valuation? If we have an on-site inspection that is asking for provisions at the same time, maybe we will take the results of this on-site inspection in, of course, also into account when deciding on this. But okay, the rule is normally except if we have very, very specific prudential reasons to modify the figures, that we take as the basis the duly verified badwill. And so that's clear. And I know this is something that was maybe not sufficiently clear on the market, so really here we want to clarify that. Normally, pending, of course, other circumstances that could happen, could always happen. We are supervisors, so we know things about the banks that maybe even the accountants don't know yet. Pending circumstances, normally we will start from the bank. So that's to be clear. On the Pillar 2, so and the use is left up to management. Of course, let me see. We are very cautious as supervisors not to make management decisions because we are here to supervise the management, so we cannot take management decisions. So what they do as management, that's fine. The only thing is that we will be looking at the management to be prudent. We are prudential supervisors and we can intervene when we think management are not doing this in a prudent way. So it's exactly the same approach that we will be there. The bottom line responsibility is for the management, but we will be looking that it is prudent given the other information we have on the situation of the bank. On the Pillar 2, what we are saying, and again, I think it was not clear in the markets, is that we stopped from the average Pillar 2 composition, which is a very easy to do. I mean, normally if you take the latest publications of the banks, you know what is the Pillar 2 requirement. Now we have published it, and you know what are the amounts. So it's very easy to do. Of course, and this is part of the early phase, if there was something that pushes us to diverge from the average Pillar 2, either in the bad side or in the good side, this is something that we shall be able to at least discuss as early as possible. So again, here, my message is, this is one of the reasons, one of the many reasons why it is useful to see us as early as possible. You can count on this average, which is very easy to calculate from outside. But if you need more insight on the particulars of the case, then you have to come and see us. On the last, which is not the least, of course, issues about the too big to fail, of course. Of course. Again, what we are doing here is not forgetting what we've done. There is a framework for too big to fail. It will be applied. If there is a merger that makes you go one bucket up, you will go one bucket up. We will be applying fully, consistently the framework for too big to fail. The only point that I want to underline, and which is very important, is that we apply it in a single jurisdiction. Where, when we want to see if a bank is too big to fail, we see it, we are Europeans, we see it from a European point of view. We do not see it from a Spanish point of view. And that changes a lot, the issue. So our only value added there, we will apply, we were part of this framework, we think it's a good framework, we will apply the too big to fail framework, but we will apply it on a European basis. That's really the message today from.
And it makes sense. It's totally compatible also with the competition rules that the relevant market is the European. So if you allow me a very final question, which is EBI related, yeah? The EBI is a joint venture of universities, and part of our work, the most part of our work is academic research on various fields concerning banking regulation. So are there any expectations from the academic world with regard to input, with regard to all these issues? Are there any areas in which you believe, we know each other for a long time and we have the opportunity to discuss these things in various fora, yeah? Are there any academic issues which you think we should more or less dig, yeah, as the European Banking Institute?
Well, I will go back to my favorite ones, and this single jurisdiction issue. I mean, I know you've been working on that personally, and a lot of people on that, but there's still a lot to be done. You know it perfectly on the liquidation, resolution, supervision continuum, on macro versus micro, how we articulate the buffers. The buffers are very well, but they were insufficient, in fact, compared to the amount of the buffers when we see the impact of the pandemic. So there's a lot, and we welcome very much interaction with academic. This is part of a transparency. I think that on SSM side, we were always well-intentioned with the academic, but maybe we could have more intense.
Thank you very much. Thank you very much, Edouard.
Then, Edouard and Christian, thanks very much for today's discussion. We're coming to the close right now. And I think it was a very lively and interesting discussion. And thanks for all your answers. To all the audience, I also would like to thank you for participating. We have our next installment of the EBI Policy Series in October, on the 14th of October, together with the Deputy Finance Minister of Germany, who is going to speak about the German program under its presidency in 2022 in the second half. And you will get separate invitations in this regard. So thanks very much and have a good afternoon. Bye-bye.